Ledger provides investors an opportunity to invest in casualty insurance. Let's look at the initial capital investment. The capital injected at time zero is deposited in the trust account and invested along with other funds. Over time, the trust account distributes cash back to the investor each year after ensuring there is still enough in the account to pay for future claims. As a result, the investor cash flows involve an upfront investment at time zero and a decreasing pattern of dividends over the next 2 to 10 years until all claims are paid, and the trust account goes to zero. However, most of the initial investment plus dividends are received within 5 years, as can be seen in the development of the multiple on invested capital, or MOIC for short. These cash flows have an attractive internal rate of return, or IRR. In total, on a large portfolio of insurance policies, for each $100 of premium collected, about $35 goes towards covering expenses and $60 goes to covering claims payments, leaving about $5 for profit. The investment income in the current environment would generate approximately another $10. The amount of capital required will naturally vary depending on the uncertainty about the amount of claims that could be paid. Given the focus on the less volatile frequency risks, the capital requirements typically range from 40% to 60% of expected losses, depending on the size and diversification of the portfolio. For our illustration, we will assume capital is equal to 50% of expected claim payments, or $30. From this, we can see that the profit includes $5 from the premium plus $10 from the investment income for a total of $15. This leads to a MOIC of 1.5. As can be seen, the capital provided by investors is subordinated by the components of profit, the embedded profit in the insurance premium, and the investment income. Now that we have seen all the components of cash flow for casualty insurance, you may have noticed something unique about insurance. In most sectors, the capital provided by the investor is used to cover the expenses of building a product or service, hoping that revenue will follow. The costs are upfront, creating negative cash flows that have to be financed by the investor. In insurance, it's the opposite. Here, the revenue is not a future promise. It is collected upfront in the form of premiums. And the costs? They come later, often many years later, as claims are paid. Amazingly, with insurance, we have positive cash flows upfront for many years. This offers a unique opportunity that is only available in insurance to earn additional profit from investing the premium. In an environment of high interest rates, these investment returns can be significant. Prominent investment companies are attracted to insurance specifically so that they can invest what is casually referred to as the float, this premium collected up front, to create leveraged returns. Ledger is building an open insurance platform to allow investors to participate in this exciting new asset class. Welcome to Ledger.